$3 million, that's the number. But here's what the title didn't tell you for the majority of people watching this right now. The real number is closer to $1.6 million, and I can prove that in about 4 minutes using nothing but your actual spending history and a social security statement you already have access to in your email inbox right now. I'm not giving you a range. I'm not doing it depends. I'm showing you the specific math, the exact withdrawal rates, the 2-portfolio structure that actual early retirees use, and the precise mechanism by which the retirement industry inflates your target number to keep you working longer than your life requires. We are starting with a payoff. We are not doing preamble. There's a hedge fund manager in Greenwich, Connecticut worth $87 million. He flies commercial, his kids go to public school, his monthly spend is about $19,000. I know this because his financial advisor mentioned it to me at a conference in Chicago, the kind of offhand comment someone makes when they're proud of their clients and relaxed on their second drink. When the advisor suggested the manager could probably afford to spend more, the guy said, and I'm not paraphrasing, more what? That's it, more what? 2 words. And those 2 words contain more financial clarity than most people will spend their entire careers trying to find. Meanwhile, there's a couple in Austin with $400,000 in their 401k who are absolutely convinced they need $15 million to retire comfortably. They've never calculated what they actually spend. They've never run a real retirement projection. They just know the number needs to be very large because they absorbed that belief from somewhere online, from someone who almost certainly had a financial incentive to plant it there. They are working themselves to death, chasing a number that was never derived from their actual life. Here's what connects those 2 stories, and it's what this entire video is about. The distance between what retirement actually costs and what the industry tells you it costs is not a rounding error. It's a multiple. And that multiple is costing people maybe years of their lives, actual irretrievable years. So today I'm going to show you real spending data, real withdrawal rates, real social security numbers, and a specific portfolio structure that makes early retirement not just possible, but straightforward. No hype, no motivational framing, numbers and incentives. That's all. By the way, I built a free early retirement calculator because most of the ones online are mathematically wrong. They ignore Social Security timing. They model flat spending for 30 years when real retirees don't spend that way. And they were built by companies that benefit from you believing you need more money managed. Mine uses the same methodology as BlackRock and Vanguard's internal planning frameworks and exposes the weak points in your current plan rather than just handing you a number. Link is in the description. Your email gets you the report. I don't store your financial data. It's free. Now, the metaphor I want you to hold for this entire video, a pressure gauge. Your financial situation is a machine with a pressure gauge on the front panel. At the low end is the red zone. That's where most of America lives, where one missed paycheck cracks everything open, where a $1,200 car repair becomes a crisis. Then there's the green zone. The machine runs smoothly. You sleep. Emergencies happen, and you handle them without renegotiating your entire existence. And then there's the far right of the dial, technically still in the green, but you've been pumping pressure in for years, and the needle hasn't moved in a very long time. The machine is not running better. It doesn't care. Your life doesn't care. The only things that care are your anxiety and your financial advisor's fee structure. And as I'll show you shortly, those 2 things want exactly the same outcome. They both want you to keep pumping. Every time I reference the gauge from here on, that's the framework. Because the entire point of this video is not save $3 million. It's understand when the needle's in the green and stop adding pressure. Here's what's actually broken in how most people approach this question. And it's not what you think it is. You probably assume the problem is information. You've started the retirement calculation a few times, gotten lost in sequence of returns, debates, or safe withdrawal rate arguments, and eventually defaulted to picking a large round number and running toward it. 7 million, 10 million, whatever feels solid. The real problem is not that you lack information. The real problem is that the data source you've been handed has a built-in directional bias. And that bias was not an accident. There's research tracking actual spending across wealth tiers, not survey responses about what people plan to spend, but measured expenditures mapped against net worth. The results are fundamentally hard to square with mainstream retirement planning content. Households with a net worth under $1 million, median monthly spending around $9,500, that's $114,000 a year. Real life, not deprivation. When you move to households with $1 million to $5 million in net worth, genuinely wealthy by any honest standard, median monthly spending rises to about $15,000 a month, $180,000 annually. Nice house, good vacations, 2 cars, private school if they want it, a real life. Now, here's where the gauge stops moving. Households worth $10 million, $20 million, even $50 million. People drawing $500,000 to $1 million a year in income. Their median monthly spend is around $25,000 a month, $300,000 a year. The needle went from $9,500 to $15,000 as wealth climbed from 0 to $5 million. Then, as wealth multiplied by 10, the needle barely moved. Same stores, same restaurants, nicer versions of the same things. That's it. People worth $20 million are spending $300,000 a year. Not $2 million, not $1 million. $300,000. The gauge hits green somewhere around $5 million for most of them. And no amount of additional pressure after that point moves the dial in any way their actual life can register. Here's a story that makes this concrete in a way data tables can't. There's a woman, I'll call her Patricia, because the CPA who told me this story asked me to keep it general, who ran a regional manufacturing business for 19 years and sold it in 2019 for just over $4 million. After taxes and deal fees, she netted about $3.1 million. Her financial advisor, who'd managed her business accounts for a decade, told her this was a good foundation and suggested she consider consulting work to build the portfolio toward a more secure level. His recommendation: aim for $8 million before thinking seriously about retirement. Patricia asked one question: what does $8 million let me do that $3.1 million doesn't? The advisor talked about options and flexibility and not wanting to run out. Patricia pressed for specifics. He didn't have any. She retired at 58. She spends about $11,000 a month. She travels 4 times a year. She has not run out of money. The gauge was in the green at $3.1 million. The advisor wasn't positioned to confirm it, or wasn't incentivized to, or both. Patricia did the math herself and trusted it. In a few minutes, I'll show you the exact arithmetic that validated Patricia's decision, the withdrawal rates, the Social Security overlay, the 2 portfolio structure. But first, I need to explain why what happened to Patricia is not an anomaly. It's a design feature. The wealth management industry operates predominantly on an AUM fee model, assets under management, typically at 1% per year. 1% sounds negligible. It isn't. Over 30 years, a 1% annual fee on a $200,000 portfolio costs you approximately $170,000 in foregone compounding growth. Not in cash fees you write a check for, in growth that never happened because the money was leaving your portfolio every year before it could compound. On a $1 million portfolio, that figure climbs past $800,000. On $3 million, you can do the math yourself. But here's the incentive problem specific to the retirement number conversation. If your advisor charges 1% of assets under management and you have $3 million invested with them, they earn $30,000 a year from your account. If they tell you sincerely or otherwise, it doesn't actually matter that you need $8 million before you can safely retire, and you spend 7 more years building toward that target, they're earning $40,000 to $60,000 annually during that accumulation phase. Then $80,000 a year once you're there. The financial incentive to inflate your retirement number is not theoretical. It is direct. It compounds. It is baked structurally into the business model. And it is almost never disclosed in the conversation where the inflated number gets handed to you. A fiscal lawyer I've worked with in Chicago, someone who has spent 25 years managing the legal and financial architecture for genuinely wealthy families, not theoretical wealthy families, told me something I've come back to constantly. He said, the entire industry runs on fear. If people realized how little they actually need to live well, half of us would be out of business. He was slightly amused when he said it. That's the version that stays with me. Not indignation, just the casual acknowledgement that this is how the machine functions. And yes, I know some of you have wonderful financial advisors, ethical people, genuinely transparent about fees, actively trying to minimize how much portfolio you need rather than maximize it. To those advisors, I say, thank you for existing. And also, I imagine your client acquisition conversations are incredibly awkward because you keep telling people good news in an industry built on delivering bad news. Here is the reversal at the center of this video. You think the problem is that you haven't saved enough money. But actually, the problem is that the target in your head, the one you're running toward, was designed by people who earn more the higher that target is. You're not behind on the math. You're being managed by an incentive structure that was never transparent about its own interests. The gauge might already be in the green. The extra pressure you're pumping might be for someone else's machine, not yours. By the way, hit subscribe if this is landing. YouTube's algorithm is not subtle or forgiving. It shows you channels you've told it you want, and the way you tell it is by subscribing. If you don't, there's a realistic chance this is the last video of mine the algorithm surfaces for you. It will categorize this as a one-time view and route you towards something with a thumbnail of a guy making a shocked face next to a sports car. Take 2 seconds. Now, the actual math, real numbers, nothing rounded to make the narrative cleaner. A married couple. Full retirement age of 67 as of 2026. Both have worked full careers. One spouse draws $4,000 per month from Social Security. The other draws $2,000. That's $72,000 a year hitting the bank account before they touch a single investment dollar. Inflation indexed. Doesn't stop when markets drop 40%. Doesn't care about sequence of returns risk. It arrives. Scenario 1, they want to spend $300,000 a year. This is genuinely lavish. $300,000 a year is the actual median spending of households worth $10 to $20 million, according to the real data. This is the ceiling model, the most expensive realistic retirement. At this income level, effective federal tax rate is approximately 35%. To net $300,000 after tax, you need about $460,000 in gross annual income. Social Security covers $72,000. The portfolio must generate $388,000 per year. Safe withdrawal rate. I'll use 4.7%, which is the upper range of what Morningstar's updated 2023 analysis considers sustainable over a 30-year horizon with a balanced equity bond portfolio. $388,000 divided by 4.7% required portfolio. $8.2 million. $8.2 million, not 15 million, not 10 million. 8.2, that is the absolute ceiling, the maximum portfolio you would ever need to fund the most lavish, realistic retirement scenario, taxes fully accounted for, longevity risk accounted for. And that's modeling a spending level that fewer than 1% of American retirees approach. Now, the realistic scenario. You want $15,000 a month after taxes, $180,000 a year. Nice house, real vacations, 2 good cars, dinner out whenever you feel like it, complete discretion over your time. This is the actual median spending of households with 1 to 5 million net worth. It's a great life. Same couple, same Social Security, $72,000 per year from the government to net $180,000 after taxes at a 30% effective rate. You need roughly $257,000 in gross income. Social Security covers $72,000. Your portfolio needs to generate $185,000 per year. At 4.7%, required portfolio is $3.9 million. Round to 4 million, $4 million. Not 10, not 8. 4 million funds, $15,000 a month after taxes in perpetuity at a historically sustainable withdrawal rate, with Social Security providing nearly 40% of your income as a floor that is completely uncorrelated to market performance. Here's something most retirement videos will not tell you because it disrupts the fear narrative. The 4% rule is not how to barely survive a long retirement without running out of money. It's the floor case, the historically terrible market sequences, the 1920s crash, the 1970s stagflation, the years that tested every assumption in average and good market conditions. A portfolio drawing at 4 to 5% does not deplete, it grows. You die with significantly more than you started with because investment returns outpaced withdrawals. The 4 million doesn't get consumed over 30 years. In most historical scenarios, it gets larger. The gauge doesn't just hold in the green, it drifts further right while you're living. This is where I want to introduce someone, because the second half of this video is about a problem that is at its core not a math problem at all. His name is Marcus. He started appearing in my comments a few months ago, always some version of the same message. He's 52 years old. He has $3.2 million saved. His wife wants to retire. He wants to retire. His stated target, $5 million minimum. His reasoning, when I asked him to articulate it, I don't feel like 3.2 million is enough. No spending analysis, no withdrawal rate calculation, no social security estimate. A feeling that, as I'll show you at the end of this video, is wrong in a specific, quantifiable, year-costing way. I've been running his numbers in the background since he first commented. I'll show you what they say shortly. But first, the early retirement math, because this is where people either save or lose several years of their working life. Here's a pattern interrupt before I continue, because I want you to sit with this for a moment. The average American works for 47 years. The average American retirement lasts 18 years. You are literally planning to work more years than you will spend in retirement. And the operational reason, the actual reason, is usually a number that was not derived from your real spending, your real Social Security timing, or your real withdrawal rate. It was absorbed from a content ecosystem that profits from your uncertainty. 47 years of work for 18 years of retirement. And people are voluntarily extending the work side because they're afraid the number isn't big enough. The number that no one derived from their actual life. Most retirement planning assumes you retire at 67 and Social Security begins immediately. But what if you want to retire at 55? Most people assume the portfolio requirement jumps dramatically. It does get harder, but not dramatically, if you use the right structure. Here is the framework. 3 types of retirement situations, each requiring different math. Type 1, standard retirement at 67. Social Security starts immediately. Everything we just calculated applies. 4 million for a great lifestyle. This is the baseline. Type 2, early retirement at 62 to 65. A short bridge of 2 to 5 years before Social Security. Additional portfolio requirement modest because the bridge is short and a higher withdrawal rate is justified for a finite window. We're talking an additional 400 to 800,000 beyond the 4 to million base. Ceiling for this scenario, roughly 4.8 million. Type 3, true early retirement at 55 to 58, a full 10-year bridge before Social Security. This is where people panic and assume they need 10 million. They don't. Here's why. The bridge fund has one job: keep you running for 10 defined years until Social Security starts. Because the window is fixed, not forever, specifically 10 years, you can use a fundamentally higher withdrawal rate than you'd apply to an infinite horizon. Research on finite horizon portfolios supports withdrawal rates of 8 to 10% over 10-year windows. The sequence of returns risk that makes 4% conservative over 30 years is dramatically reduced when you have a defined endpoint. Let's use 9%. I call this the 2-tank strategy. Tank 1 is your bridge fund. Tank 2 is your long-term fund. Different jobs, different time horizons, different withdrawal logic. Managed separately. Tank 1, the bridge fund runs at 9% withdrawal. To cover 180,000 after taxes. 257,000 gross for 10 years at 9%. Bridge fund needed is $2.85 million. Call it 2.9 million. Tank 2, the long-term fund, stays invested during your bridge decade. You don't touch it. It grows at 6% annually. You need it to reach 3.9 million at year 10 when Social Security kicks in. Working backwards, from 3.9 million at 6% over 10 years, You need 2.2 million in tank 2 on retirement day. Total 2.9 million plus 2.2 million. $5.1 million. Call it 5 million. That is the ceiling for early retirement, 55 years old, $15,000 a month after taxes, historically sustainable, with Social Security adding roughly $72,000 per year as a permanent income floor at year 10, 5 million. That's the hard ceiling for the entire concept of comfortable early retirement. The gauge is green at 5 million for this scenario. Firmly, the machine is running. Let me make this concrete with a real scenario. You're 45 years old right now, married, combined household income around $200,000 a year. You've got 1.2 million saved across your 401ks and IRAs. You want to retire at 55. You currently spend about $120,000 a year, and you expect to spend $140,000 in retirement, a bit more because you'll have free time, a bit less because the mortgage is paid off. If your portfolio grows at 7% annually for the next 10 years, conservative for a diversified equity-heavy allocation, and you keep contributing $35,000 per year combined with your employer, match. You'll reach approximately 3.7 million at 55. Two-tank split, 1.6 million goes into the bridge fund. 9% withdrawal covers 140,000 after taxes for 10 years. 2.1 million goes into tank 2, grows at 6% for a decade, reaches approximately 3.75 million at 65. Social Security kicks in, let's say you draw 45,000 combined, both of you having contributed your whole careers. Your portfolio now needs to cover about 115,000 annually gross. 3.75 million at 4.7% generates 176,000 per year. You have meaningful buffer above your spending requirement. You don't need 7 million. You don't need to work until 62. You need to keep doing what you're already doing for 10 more years, and the math is finished. The gauge hits green at 55. Every year past that you're still working, you're pumping pressure into a tank that's already exactly where it needs to be. Now, I have to stop for a second. There's a guy I've been watching in a FIRE community forum for about 2 years. His original retirement target was $4 million. He hit 3 million and revised it to 6 million because he discovered geographic arbitrage might not be permanent. He hit 4 million and moved the target to 9 million after reading something about long-term care costs. He is currently sitting at $6 million, and his new number is 12 million because, direct quote, who knows what healthcare looks like in 40 years? His actual monthly spending, $6,000 a month. He is a single person spending $6,000 a month who has built an increasingly elaborate mathematical architecture justifying his inability to stop working. Someone in the comments suggested he talk to a therapist. He responded with a 17-paragraph thread on Monte Carlo simulation methodology. His gauge has been in the green for years. He's standing in front of it, watching the dial, waiting for a feeling that the dial does not produce because it was never a dial problem. Now back to Marcus, because his numbers are done, and I think this is going to land differently than he expects. Marcus is 52, 3.2 million saved, monthly spend. He told me it's about $9,000 a month, $108,000 a year. He and his wife are targeting 62 as their retirement date 10-year bridge from now. Bridge fund to generate $108,000 after taxes at roughly a 27% effective rate. He needs gross income of about $148,000 annually. At 9% withdrawal over 10 years, bridge fund needed is $1.65 million. Marcus has 3.2 million. He allocates 1.65 million to the bridge fund. The remaining 1.55 million goes into tank 2, grows at 6% for 10 years, reaches approximately 2.78 million at 62. Social Security kicks in both spouses with modest contribution histories. Let's model 35,000 combined per year at 62. His portfolio now needs to cover roughly 113,000 gross annually. 2.78 million at 4.7% generates 130,000 per year. With buffer, Marcus, you are done. You have been done for at least a year, possibly longer. The 5 million in your head is not a retirement calculation. It is a feeling wearing the costume of prudence. The gauge is in the green, the machine is running, you are adding pressure to a system that is already operating exactly as it should, and the cost of that additional pressure is measured in years. Your years. And this is the insight the entire video has been building toward, the one that applies to Marcus and to the Reddit guy and to the couple in Austin and to Patricia and probably to at least a few of you watching this right now. There's a mechanism in behavioral economics called hedonic adaptation. The brain normalizes any new level of wealth or security within weeks and immediately begins scanning for what's still missing. It's why a salary increase feels wonderful for about a month and then becomes the new baseline. It's why you buy the thing and it doesn't transform your life the way you anticipated. In retirement planning, this shows up as an endlessly moving goalpost. I'll feel safe at 3 million. Then, at 3 million, I'll feel safe at 5 million. Then at 5 million, actually 8 million is more comfortable. The number grows, but the feeling never arrives because the feeling was never about the number. The number is a proxy for a question you haven't answered yet. What do you actually want your life to look like? The hedge fund manager in Greenwich answered the question. He decided what his life was supposed to look like, ran the math to confirm it could be supported, confirmed it could, and stopped. He didn't wait for the feeling of safety to arrive as a sensation. He trusted the math as a foundation and stopped pumping. The couple in Austin hasn't answered the question. When we have 15 million, then we'll figure out what we want. But the 15 million wasn't derived from any analysis of the life they want. It's a large, round, safe-feeling number that absolves them from having to answer a harder question: what do I want to be doing at 9 in the morning on a Tuesday in retirement? A larger portfolio doesn't resolve that. The question gets more expensive to avoid, but it doesn't go away. Here's what you lose by operating with the wrong number specifically, concretely, in a way you can't recover. If your real portfolio target, based on your actual spending and your real Social Security estimate, is 4 million, and you reach 4 million at 60, but believe you need 8 million, you will keep working until you hit 8 million. For most people in that situation, that's another 5 to 8 years. The years between 60 and 68 are the healthiest years of retirement you will ever have. Your mobility is at its peak. Your cognitive engagement is highest. Your energy is highest. Every major study on retiree health confirms this. The early years of retirement are not equivalent to the later years, and they are not recoverable. If you spent those years at a job you were finished with because of a number that was built to inflate your anxiety rather than describe your actual life, that is not a philosophical loss. It is a practical, permanent, quantifiable one. 5 years of your best retirement years spent in an office because someone had a fee structure that rewarded your uncertainty. 3 practical takeaways specific to this math, not generic retirement advice. 1, calculate your actual monthly burn rate for the last 6 consecutive months. Pull every bank statement, every credit card statement, every subscription you've forgotten about, every cash transaction you can account for. Add up every category. Do not estimate from memory. Research consistently shows people underestimate their real spending by 30 to 40%. Your retirement number is not an abstract figure. It is a direct multiple of your specific monthly spend, applied to a withdrawal rate, adjusted for taxes and Social Security. If you don't know your spend within 5% accuracy, your retirement calculation is not a calculation. It is a guess wearing a spreadsheet. You cannot know whether 3 million is enough or you need 5 million until you know this number precisely. The denominator determines the entire equation. 2, log into ssa.gov right now, authenticate your account, and pull your personalized benefit estimate at your specific target retirement age. Write the actual number down, not the national average you've seen cited in articles, but your number based on your actual earnings history. Your Social Security benefit is not a rounding error in this math. A combined spousal benefit of $45,000 to $72,000 per year is at a 4.7% withdrawal rate, the equivalent of $1 million to $1.5 million of portfolio you don't have to build. Most people I've spoken to underestimate their own Social Security benefit by 30 to 40%, which means they're overestimating their required portfolio by hundreds of thousands of dollars, sometimes over $1 million. One number, one login, potentially shaves a year or more off your timeline. 3, if you're within 15 years of your target retirement date, start separating your portfolio into 2 tanks. Bridge fund for the pre-Social Security window. Long-term fund for everything after. Model them with different withdrawal rates, different investment allocations, different time horizons. The bridge fund is not a retirement portfolio. It's a decumulation account with a finite endpoint, and it supports a withdrawal rate roughly double what you'd apply to an indefinite horizon. Running both tanks as one undifferentiated pool forces you to use conservative, indefinite horizon math on money that has a defined 10-year job, and that structural mistake alone adds meaningful portfolio requirements, sometimes hundreds of thousands of dollars to your perceived target. That's the kind of error that quietly adds years to how long people feel they need to keep working. And almost nobody's financial advisor explains it because the conversation stops being about building wealth and starts being about distributing it, which is a different skill set and a considerably less profitable one. The pressure gauge is the whole game. The green zone is real, it's achievable, and it is significantly closer than the number someone else put in your head, unless that number came from your own math, which it almost certainly didn't. Lazy investing built more fortune than crypto memes. But knowing when the gauge is in the green and the machine is already running fine, knowing when to stop pumping pressure into a tank that's already there, that's the part nobody gets paid to teach you. Most of you will watch this, absorb the math, and find a reason it doesn't apply to your specific situation. The brain is very good at protecting its own anxiety. That's fine. At least now you know what the gauge looks like when it's green.